Welcome to the Toronto Real Estate Podcast. Today we have, back by popular demand, friend of the pod, Ben Myers. Ben is president of Bullpen Research Consulting, which is a boutique real estate advisory company with a specific focus on new development in Ontario, but more so, I think, in the GTA area. Ben, so great to have you here.
Thanks for having me back, Ralph. Happy to chat.
Awesome. So we're going to talk all things Toronto real estate. But before we get into it, please be sure to hit that like or subscribe button. I always forget to ask, so I'm making a point of it. And if you have any comments, we'd love to hear from you down below. So let's start with the Armageddon that is the pre-construction market today. Ben, how bad is it?
Yeah, it's about as bad as it has been at any point in Toronto's history, right? It's we're reaching levels that we saw in the early 1990s recession. So projects obviously are not launching because sales are not happening, and new launches drive sales typically. But there's a disconnect in the marketplace, right? The cost that developers would need to charge to make a profit is higher than what people want to pay, and that cost was driven up by a lot of factors. And I've talked about the kind of toxic soup of occurrences that kind of led to the 2021 and early 2022 bubble, the price increases and inflationary increases on products due to COVID-19 and due to the pandemic, increases in many cases 30-40% in development charges. Obviously, land prices went up dramatically. So there was, as an economic term, there was lots of cost push inflation in the marketplace, but there was also demand pull inflation, record low interest rates, so which drove people to buy condominiums, and then prices were going up dramatically, and that drove investors to continue to buy units. So we got to the point where there was a complete disconnect between the underlying market, what was in the resale market, what people's incomes are, and what was being charged for new condominiums, and the market just simply broke. The higher interest rates, kind of cracked that marketplace. So when we had prices had increased in the new condo market for 27 consecutive years. So it really was an unprecedented run that no other North American city had ever seen. And then it just went off the tracks. It was a roller coaster, with small little bumps, but then this one went firing up, it just wasn't sustainable. And the market is broken. And because this is such a lag in our market in terms of when sales occur, when construction starts, when buildings complete, that can be a 4, 5, and even 6 year period that we really have to wait it out and have wait till a period where there's almost no completions in the marketplace. That starts to drive rents back up. That starts to drive prices back up. And that's when people will start buying new condominiums again. So, I'm telling my clients that it probably won't be quote unquote safe to launch a project till 2028. So that's kind of we're still in the kind of the depths of the cycle now.
2028 might even be optimistic. Like, I really honed in on the word that you used, which is disconnect. And there is a symbiotic relationship to a degree between pre-construction sales prices, price per square foot, and resale. And that disconnect is the spread is so far. And it's one of the things why this is such an interesting scenario, because in most markets where you have diminishing sales, usually price will come down to meet demand. But because in pre-constructions, all of these costs are so fixed, it's not simply like, a developer can say, okay, working on 8, 10%, maybe 12% margins. Oh, let's not launch at $1,550 a square foot. Let's just blow this out at $1,200 a square foot. It's not possible. And the disconnect being, if you look at a pre-construction project at $1,500 or $1,600 a square foot, which would be probably what we'd be looking at in downtown Toronto, and resale at $1,000 or maybe even less in some circumstances, $800 or $900, there's a real disconnect for investors and for end users to make sense of it. And until that rectifies, or that spread, that gap becomes a little bit more in line with historical norms, we're going to be in this situation, I would think, for a while.
Yeah. So going back to, when the market really started to take off, and in the early 2000s, kind of that, 2005 period, new condominiums were selling at 5 to 10% premium above resale. You were buying something that's brand new. You're buying a condo market future, essentially. So you're buying something in the future. Buyers were anticipating that prices would continue to go up, which is not uncommon. We generally get inflation, and inflation happens in the housing market. And then fast forward to maybe a year like 2017, where prices were really going up, and investors were made up a much higher proportion of the marketplace, and they might pay 15 to 20% more. Part of the reason for that is we're building bigger towers, right? So when you're buying this condo market future, it's now, instead of it being 2 years out, it's now being 3 or 4 or 5 years out. So if they were anticipating that it's going to take 4 years, and they think prices are going to go up 6 to 7%, then they were willing to pay that price gap. But once we got to 2021, we were seeing projects with 40 and 50% premiums above resale. And I, to the life of me, didn't understand why investors were continually buying that product. It just didn't make any sense to me, because given the carrying costs and given what else would be out there for an end user to buy and an end user to rent, it made no sense. So we've got to the point now where this model is completely broken, and people are anticipating prices to go down. Right. So if investor is looking at a condo market future and they're saying, okay, in 3 years or 4 years from now, I actually expect prices to be lower. So you actually want to pay less than the resale market today. And as you know, no developer can make a project work at less than resale, given where costs are today. Land has come down 50%, but land's only 10% of the market. Construction costs have come down 15 to 20%, but it's still not enough to move the needle. That's why developers are continuously asking for relief on development charges. They're asking for relief on HST. They'd love for the land transfer tax to be removed, and in Toronto, the double land transfer tax. If they can defer some of the building permit fees, if we can take down some of the Section 37 or community benefit charges. I don't think the average person realizes that over 30% of the cost of a new home goes to various taxes and government fees. Some of them obviously are used for infrastructure, very much needed, but you look at many American cities and that's like 6 or 7%. If you look at a project where the average price is of a unit was $1 million, in many cases, 330,000 to 350,000 of that was going to government fees. Where I used to live in Dallas, Texas, you could buy a full 1,000 square foot unit for $350,000, right? So we were paying more in taxes than someone was just paying for a unit that's probably 40% larger than the average Toronto condominium. So it really is a pain, and we decided a long time ago that we were going to make growth pay for growth. We wanted to make all the new units pay for all the infrastructure. And then the existing people that live in the city get to now use that infrastructure. They get to use those community centers, and they get to use those parks, and they get to use that transit. So instead of that debt being held by municipalities in the form of bonds and things, it's now being passed on to purchasers, and then they have to fund. And we pay interest on those purchases for 25 years. So it's not a very fair system. I've always used the example of my son's looking to buy a new condominium. He buys in a resale building, then he doesn't have to pay for growth. But if he moves into a new condo building, then he does have to pay for growth. Why does he have to pay for one versus the other? It doesn't make a lot of sense. I think there's people who think that every new condominium is filled with all newcomers coming from first-time buyers and people moving from other cities, right? It's made up of people that have been paying taxes here their entire lives. So it doesn't make a lot of sense that we have to put that entire burden on them. And then when you see development charges being used to rename Yonge Dundas Square, that's the type of thing that just make you just infuriated, right? Why would new condo buyers have to pay for the name change of Yonge Dundas Square? What's wrong with the name Yonge Dundas Square? It seems makes it easy for people to find. So anyways, get off my soapbox for a bit.
Awesome. I think that topic might be a whole podcast
Yes, exactly.
in and of itself. But it goes back to what you were saying earlier: is the system broke, and you just keep putting more and more weight on it, and you keep putting more and more capital out of it. Eventually, as prices continue to rise, in order to keep feeding it, it's going to hit a breaking point.
Yeah, and yeah, we had tried to get around increasing cost by shrinking unit sizes, right? We wanted to keep the end selling prices low, so we continued to shrink units, but you could only shrink them for so much. We had almost got to the point where every developer had code minimum sizes, and they were trying to, some were increasing the share of studios, but not as many as people thought. That was the big, we're all building Airbnb units, but for the most part, most developers weren't doing more than 10% studios. So that was a little bit overblown, but affordability is a concern, and selling prices is a concern, and if you keep loading up the costs, then something has to break, and ultimately it broke in a really nasty way.
So yeah, and here we are. But all of the factors that you mentioned, from development charges to HST, etc., there doesn't seem to be any type of a reset. There's been some conversation, but it doesn't seem like, while things are broken, politicians or policy is changing in a way that's going to let the industry get back up.
Yeah, I think, and it's going to take prices going up and rents going up dramatically. That's the only time they're going to start to hear, their constituents start complaining. And as you know, we delivered 32,000 apartment units in the Toronto CMA, and I'm talking condo and rental in 2023. 31,000 last year. We've delivered 25,000 through the first 10 months of this year. So potentially looking at another 3,000 or 4,000 in the final 2 months of the year. So we've essentially had will have three consecutive record years, and then another year in 2026 at near record completions, all based off of the boom years of 2018 to early 2022, taking out 3 months during COVID. March, April, May of 2020 was the only 3 months where sales weren't near record levels. So we'll deliver the supply, and that, as we've talked about many times, on my podcast and on Twitter or X, about supply and demand. Supply and demand is undefeated. We've delivered more supply than we have underlying demand for, which I estimate is somewhere between 25 and 30,000 units. I err more on the side of 25,000. So we've over-delivered supply in the marketplace, and rents have come down. And so we're likely to see rents and prices either come down or stay flat for at least the next couple of years, 2026 and 2027. So in 2028, we're going to be delivering probably half of the needed supply. So, based off of projections, we could be somewhere 8 to 12,000 completions in 2028. And I'm talking apartment completions, so purpose-built rental and condominium apartment. And that'll be half of what's needed. So we're going to see rents going up. We are going to see prices going up. I can guarantee that. I think it's going to be 5 to 7%. It could be higher. But I think the overhang of all these units that we've completed over the last 3 to 4 years will be gone. They'll be lived in, and we'll start to see prices go up. And that's, I think, finally when the politicians will start to hear from their constituents, not just the development industry. As you know, the politicians are not that sympathetic to real estate developers, especially when they look out their window and they still see lots of cranes, and they see prices going down. They're like, "Oh, this is great, right? This is exactly what we need." So until we start to see things turn, then I don't think we're going to see much sympathy. And even the municipalities that have, like Mississauga, has reduced development charges, and Vaughan has reduced development charges. But Vaughan really only put them back to 2019 levels. So even though they've reduced them by like 40% or 50%, it's really only bringing it back 5-6 years of increases that they already put on top of them. So it's not moving the needle enough to get supply going, and they tinker at the margins with with six-story wood frame and small apartments and missing middle. But yeah, I mean, we're no longer building 700 unit buildings, and now we're trying to make up with that with fourplexes and sixplexes. That's a lot of fourplexes and sixplexes to even make up one downtown Yonge Street condo project, right? So we're not going to meet anything near the demand that we want through small scale developments and through government led affordable housing projects.
Really? You don't think the government's going to solve the housing affordability crisis?
Yeah. Good luck shocking. With Anna Bailão and Build Canada Homes. But let's be honest, we've seen these announcements over and over and over again. We're just now seeing the Housing Now projects get under construction that were announced by Tory. I mean, I haven't said the name John Tory in 5 years, it seems like. And,
might be making a comeback, I heard somewhere.
Yeah, I think 5 years out, we start to forget about, cheating on your wives, I guess. But I guess you can cheat on every one of your wives and get with porn stars and be president of the United States. So I guess John Tory, he's light in comparison to others in the political arena that seem to be successful. All right,
I guess so. And I think part of the problem, going back to the pre-con market, is when are we going to see investors coming back? Because it's the small scale investors that were really driving the market, and it's the only real hope of them coming back. So part of it is we're going to start to see no supply on the condo side coming online in 2028, but it's going to take, in my opinion, time to get resale prices higher to justify the pre-construction prices. And then you've got to see investors come back, and I don't know. I think it could be a long time before we see that. Like, how do you think about these small scale investors who are the ones who traditionally drove the condo boom?
Yeah. I think if they see prices come up, I think a small percentage of those will be the ones that jump back in. I don't think we're going to see 50 and 60 story towers with 600 and 700 units. I think in the buildings that are going to come online, if they do start seeing high-rise projects launch in 2028, they're going to be 25, 27 stories. They're going to be 150, 200,000 square feet of GFA, maybe 150 units. They're going to be much smaller scale, require fewer investors. The fundamental problem, obviously, as you know, investors have been in the market for capital appreciation, haven't been in the market for cash flow. So we haven't seen units cash flow in 10 years. And so if you're only in the market for capital appreciation, then, you probably want to see at least a decent amount of time of price growth. You might want to see 6, 8, 9 months before you start saying, okay, this is not a dead cat bounce, or this is only temporary, right? You might want to see that a longer. The other problem, obviously, fundamentally, is how many investors got hurt during this last cycle and lost a lot of money and say, hell, I ain't doing that again, right? So there's certainly a lot of those. And then even the ones that actually like investing in real estate, well, part of how they invested in real estate is they took the equity out of their previous units that they bought that were equity positive, borrowed against those units to buy new units. So now if that equity doesn't exist, then they can't use that model anymore, right? So that's why I think we're not going to have a year of 30,000 sales for 10 years, maybe 15 years, maybe never, right? We may never have another year like that. Maybe the golden age of pre-construction condominiums is over, and we're going to start delivering much smaller scale product. But people don't understand how unique Toronto is in the global perspective in terms of our pre-construction condo market. There's really nothing like it anywhere in North America. If you do tours, I went on a build tour, ULI, I can't remember which one it was, to Boston. And we toured a project, and it had been completed for 18 months. And they're like, yeah, we're pretty excited. We're 45% sold. And I'm like, you've been completed for 18 months and you're excited that you're 45% sold? And basically every unit that was for sale in the market in Boston was $1,000, $1,200 a square foot, and they're big, right? So a lot of their market only caters to the luxury, right? If you're only going to build 5,000 units a year, then you're going to concentrate at the highest the highest income units in the. So if you, like they said, if you told Toyota you could only deliver so many cars per year, you're going to build the Lexus. You're not going to build the Corollas, right? You're going to build the cars that have the highest margin, and so that's unfortunately where we may be headed. We may be only building boutique, higher end projects for people who are less impacted by interest rates and changes in housing equity and housing values. And I hope that doesn't happen. I think it's great that we deliver so much housing for quote unquote first time home buyers or young professionals. There's not many other markets that do what we do or did what we did, and it would be disappointing to see that market completely collapse and never come back.
Yeah, it'll be interesting. I think the golden era isn't necessarily the golden era of the condo market or pre-construction market, but it's almost like the golden era of home ownership. I think as time goes on, it's going to be harder and harder for people to actually own the dwelling that they live in. And if you look at all of the government's activities and verbiage, it becomes really clear that they're focused on just delivering rental, and that's really their big focus. And you're also seeing that from a lot of developers right now, typical condo developers. What are you seeing with that shift from developers from moving from condominiums to purpose-built rentals?
Yeah, obviously developers much prefer to be in the condominium apartment market. Obviously, it requires much less upfront equity, and developers typically take the deposits and borrow against them to allow them to get construction financing. There's typically some land lift. The value of their land is gone up. They use some of that as equity. But in the rental market space, they typically have to put in much higher equity. Often as much as 30 or 35%. So if it's a $100 million building, that's a lot of cash, and there's just not a lot of people that have that in their genes, and the ones that don't have to go out and raise that. And it's obviously not a great time to go out and raise funds for the apartment market when rents are trending down and prices are trending down, right? But
what about the CMHC? They've been very
so that's everyone's applying for the various CMHC programs, and what's great about that is they require a market study. So
very convenient. Do you know anyone who can do a market study?
Yeah. So please call Bullpen Research and Consulting. But no, I've been very busy with that, working on those types of studies. But there's a silver lining for developers, bad for tenants, obviously. That is, like we mentioned, 2028 is going to be a lack of supply. 2029, 30, 31, we're going to be delivering almost no product into the marketplace, and rents are going to go up. So ultimately, today is the best time to start building a rental apartment if you have the capital to do so. And unfortunately, we are trending towards a much higher share of renters and tenants in the Greater Toronto area. Unfortunately, there's only so much land available. So there's the cheap land that fueled a lot of the construction boom in the early 2000s and 2010s. That land is no longer available. Vendors can look and say, I got a restaurant, I got a parking lot, I got retail. I like it. It's making money. I'm in no rush to sell it to a condo developer, especially now where the market's down. Why would I sell it now for $50 per billable square foot when I just saw 3 years ago or 4 years ago people paying $200 per buildable foot? I'm just going to hold on to this, and it'll probably be worth more in the future. So we're not going to see land come down a lot. And we've transferred how we build housing from suburban, low rise, wood frame, easier to finance, easier to sell, easier to build, to high-rise product that's concrete and has to go underground and has to go through a much more rigorous planning process and NIMBYs and higher development charges and you add on. And so the price per square foot is $1,000, $1,100, $1,200, where you go up to the burbs and it's $500 a square foot. I know people don't like to compare price per square foot for high rise and low rise, but essentially you're getting a much bigger bang for your buck for low rise, and that's disappearing because we've got a green belt. We have places to grow, and just the difficulty of driving anywhere in the Greater Toronto area now. And so we've moved to a much higher cost of delivering housing, and replacement cost has an impact on the cost of resale housing. I know there was the PhD realtor in Toronto thinks it has no impact, but it has impact. You can look up replacement costs of housing and the impact on resale values. It's pretty common. It's a well-known economic phenomenon that's been studied not just in housing, but many other avenues. So that's why you really shouldn't get all your advice on Twitter from, no offense to realtors, but there's ones that maybe should stick in their lane a little bit more. And are
you referring to something specific? I feel like you are, Ben.
Yes, you can go on Brandon Donnelly's blog, and he covers some of this stuff. So a shout out to Brandon. He's one of the smarter guys out there. So I'm sure many of your listeners subscribe to his newsletter, but he's covered off some interesting things that some of the so-called experts in our marketplace have talked about. So unfortunately, there's a lot of disinformation. I'm an expert in a small box of things in a new housing market, but I try very hard, on my own podcast, the Toronto Under Construction podcast, available at all your favorite podcatchers, to have conversations with experts in their fields, right? To understand the financing, to understand the construction, to understand the sales process, to understand, the risks that developers are going through. I try to ask those questions from a lot of people to fill my knowledge base. I don't try to fill it in with narratives that are convenient to me or narratives that I think are going to get me more likes on Twitter or LinkedIn. I'm trying to just be correct. I mean, that's ultimately that's what gets me going is being correct and providing information that's an analysis that helps my clients out. So that's my number one goal.
And staying on the purpose-built side of this conversation or track, are we overbuilding? There seems to be let's keep it to Toronto, but do you think that there's too much purpose-built rental supply coming on the pipeline, or where do you think we're at with that?
Yeah, no, I mean, obviously, I think we can absorb probably 15 to 25,000 units of rental in the marketplace. Maybe not 25,000, but at least 20,000 units of rental in the marketplace. And previously, as you know, that had been 75 to 95%. Condominiums for rent had made up that rent supply. And so that's going to, the purpose-built rental is going to take a much higher share of that in the future. It might even come up to 50%. But again, we may talk about 5,000 to 7,000 units of the, the 10 to 14,000 total apartment units that we get in the marketplace. So no, I don't think we're going to be in any trouble of oversupplying the purpose-built rental market. I mean, obviously now we see pullback in rents and higher incentives just because the overall housing market has oversupplied. But not the purpose-built rental. Its component will always be fairly small given the high upfront costs of getting a project financed. And then, you have to unlike a condominium where you sell the units and that's where you get the money to pay back your construction loan. And in a rental, well, you have to refinance that building, and that has uncertainty involved in it, right? When you sell a pre-construction condominium, you have a contract if the person agrees to pay that. Obviously, we have some issues with some people, some people's inability to pay what they put in their contract, but they have a contract that says they have to pay it. So they can be there can be penalties for not paying it. So on the rental side, though, you can come to very experienced people in forecasting rents, and they can be wrong. Like certainly, I can be very wrong in terms of where I think rents are going, and so that's a significant risk. You build a building, and it might take 3-4 years. Well, the rent may be lower, the cap rates may be much different than you forecast, and you maybe have come up with a situation you have a significant shortfall in value, and that can be I'm not an expert in the contracts there, but that can be very damaging to yourself and your financial partners, and so there's much higher risk involved in rental. So we're just not going to see as much of it.
What I worry about as a landlord myself, small landlord, is rent control. And I think a lot about it in terms of right now we have a tremendous divergence in wealth. We have massive wealth inequality. And you're seeing some extreme reactions to it, both like on the left and on the right side, trying to sort of navigate through this issue that's really, I think, tearing apart or causing a lot of conflict in society. It's manifesting in a whole bunch of different ways. And housing inaffordability is only, in my opinion, just a big symptom of the greater inequality in wealth. And it's causing a really big divide. And as you know, we have two tracks, one with rent control built prior to 2018 and after 2018, non-rent control. And rents are going to go up, supply is going to get choked, demand is going to go up 2030, 2031, 2032. And you look at like Mandami in the most capitalistic city in the world, now the new mayor or about to become the new mayor, and you look at what his intentions are, and you look at our Mandami light version here in Toronto, just a little less effective. Lunatic,
it's certainly not as charismatic, that's for sure.
Exactly, not a slicker talker. Mm-hmm. He's a 32-year-old TikToker who can talk. He's and he can probably execute to a degree. And so, unlike what we have here in Toronto, which is just a big mess. But you see symptoms of that. And I think if she had more power, similar to what the province has, I think she would bring in stricter rent controls than what we have right now. And you look at, it's a provincial decision for rent controls or the rental market. And Doug Ford will not be premier forever here in Ontario. And you look at what the NDP is promising and the Liberals are promising. They're both promising rent control, and there's different versions of it. Even the rent control that we do have, properties built prior to 2018, that's like rent control light. Like there was a time in the 70s, 80s, 90s, I believe, where rent controls, the rents actually stayed with the unit. It wasn't just like you could only raise rent by 2% or whatever, the board deems as fair per year. But when a tenant would move out, in our version of rent control prior to 2018, you can raise the rents to market value. At that time, you could not, and the rents would actually stay they were locked in with the unit. And so, the effects of that long term on supply were devastating, and it's why no apartment rentals were built in Toronto for 30 years. I could see something like that coming back at a future date. Is that ever on the mind of purpose-built developers, pension funds, making these massive investments, thinking about what could come in 3 or 4 or 5 years?
Yeah, I'm surprised that it's not more. In some of the conversations that I've had, I mean, we are seeing so much polarization and so much pushing out to the right for the the right-leaning people and to the left for the left-leaning people. And unfortunately, there's no such thing as a free lunch. I mean, that's just a common economic saying. Someone has to pay. Right? So if you're not, if you're forced not to charge the market rate for that unit while your costs are still going up, your mortgage is going up, your maintenance fees are going up, your repair costs are going up, you are going to there's a few different options. You can, not maintain your building, and that's not really good for a tenant to not have their building maintained. You don't want building collapses and roofs collapsing in and water not being fixed and heat not being turned on. So that's obviously bad. Or someone like you who might own a condominium, once that tenant decides that they're leaving, I'm just going to sell this thing, right? I'm tired of being a landlord. I'm tired of not getting a good return on this. I can put my money in this, safe government bond and make a guaranteed return. And why put myself through
I'll buy
these
like
headaches?
Nvidia. I'll buy Nvidia stock at
Yeah.
140 times price per earning.
Well, yeah, you can buy some crypto or something, some Trump crypto. Uh, but I mean, it just eventually, if the fear becomes strong enough, then yeah, a rental developer is not going to build a rental, or for the very least, like they do, like many of the developers do in London and other cities in North America, is they register the building as a condominium. They may start out as a rental building, and then if they feel that the policies have changed for the negative, then they'll just start selling the units off, and they'll maintain the right to do that because it's registered as a condominium and not a rental. So unfortunately, that's the way it typically goes.
One of the things, Ben, that I've seen you specifically talk about that I think is really, really interesting is there's this narrative about shoebox condos and evil, greedy developers pushing this onto unassuming consumers. And now we have all these unlivable condos. But yet you compared it to deliverables with purpose-built rental developers. And it was really interesting, some of the stats you came up with and some of the points you were making between looking at what's being delivered between, in the past, condo developers and today purpose-built developers in Toronto. Can you talk a little bit about that?
Yeah, I pulled some rental data that I have. It's actually 340,000 listings over the last I think it was 7 or 8 years that I have compiled in my giant spreadsheet. And so luckily I've looked at the occupancy, or the first occupancy date for these buildings, or when they were completed, and I looked at the size of the units. So I've got a pretty decent size sample of these units. So I looked at buildings in Ontario that have been completed over the last 10 years, what the share of studios is, and so for rental and condo apartments, the share was almost exactly the same at about 8% of the units being studios. And what was the average size in a condominium apartment? It was 448 square feet. And what the average size of a studio in a purpose-built rental? 443. So actually lower. But the funny thing is I look back at what the size of a studio was for different time periods. So I took a time period of 1950 to 1979. So buildings built in Ontario. The average size of a studio for buildings built in that stretch, 418 square feet. So the shoebox unit is not something new. It was actually 10% of the units being built in those rental buildings, that were built in the 50s, 60s, and 70s. Was 10%. The share was higher than it is today, right? So this narrative of all developers are building is shoebox units. Yeah, they built small units, but it's hardly any difference than it was, many years ago, right? So the focus on 5 to 10% of the units being built versus the other 95%. I mean, I would love to live in a 1,700 square foot penthouse condo. I mean, that would be fantastic, but that requires more material, and that requires, a lot of other resources, and the cost is much higher. And therefore the cost is, a developer has to work around affordability. There's no other way around it. And if people can't afford their unit, why would they program it, right? I've always said, if you want a large 3-bedroom condominium, then buy one in a pre-construction condo. And if you say, well, it's too expensive, then I would say, okay, well, why don't you go to your municipality and say, why are development charges so high? Why is there all these building permit fees? What is this Section 37 of this community benefit charge? Why is that so high? Why is there a double land transfer tax? Why is there HST and GST on housing for second-time buyers? They're trying to eliminate it for first-time buyers, but why not second-time buyers? Like, why am I being discriminated against, right? Or why am I not getting the same deal as somebody else, right? So Smaller units is just a function of the monthly payment and what someone can afford. So rental developers are trying to cater to a section of the market that's affordable too. I mean, I think they are building larger 2-bedroom units and they're building larger 3-bedroom units, but they're catering to a slightly different tenant profile in those buildings. So the data always tells a slightly different story, and people get caught up in the narratives and they caught up in developers being greedy. Guess what? If a developer could build 1 unit on every floor, they would love that. That is a more efficient building because there's fewer hallways and there's fewer elevators. So a more efficient building, more square footage to sell. If you have 1 unit on a floor, then you'd probably maybe have 3 bedrooms or 4 bedrooms or 5 bedrooms as opposed to 10, 15 on a floor. So less walls, less front doors, less kitchens, less pillars, support pillars, right? Like everything would cost more. Everything would cost less, than building small units. So it's a fallacy that a developer goes through and says, okay, what's my profit on a studio? What's my profit on a 2-bedroom? What's my profit on a 3-bedroom? That calculation is not done, right? The calculation is on the entire building. What does the entire building produce? What is a sweet mix that I can sell? And what's going to, obviously they want to maximize their revenue, but in a rental building, you have to take into consideration, obviously, the long-term viability of the project and the long-term demand. And the fact that condos and rentals are ultimately producing a very similar unit mix shows you that the condo developers and the rental developers are similar in their mindset in terms of what demand, ultimately end user demand is in the marketplace.
And affordability. Like this is really what it comes down to,
Yeah.
is what people can afford.
Exactly.
And one of the things that I think we talked about this, I remember this in the spring, is you can have a 500 square foot suite and a 750 square foot suite, and the 550 square foot suite is far more livable and would be a better place to be in spatially than the 750 square foot or even 1,000. I long time ago lived in a shoebox condo, and it was a corner, and it had a balcony, and it had 10-foot ceilings, and had lots of natural light, and it was a perfect square, and there was no wasted space, and there was incredible flow. It was in a great neighborhood. Like, I don't know what people are freaking out about. Like, if you have quality product, people are going to live in them. And it's like this idea, all these, mostly boomers just going on because they grew up in a 3,000, or 5,000 square foot house and only use 3 rooms. Like, even when I talk to downsizers and we help them make that adjustment, you sit and you're like, okay, you've got, I don't know how many rooms in your house and 5,000 square feet above ground or whatever it is. It's like, where do you really spend your time? Well, I spend my time in the kitchen and in the living room and my bedroom. Like, do you go down to your basement? Never.
Yeah.
It's just crazy to me that people go off and off about this. It should be the quality of the product, not the square footage.
And I think, I will be critical of developers. There's some pretty bad floor plans that got launched in 2021 and 2022. True. So I think this downturn will have a positive impact on unit design and flow and all that types of thing. But the point I always make is, at any one time, if you go on to rentals.ca or torontorentals.com or Kijiji, there are thousands and thousands and thousands of units for rent. There, in any one time, there's probably 20 to 25,000 units for rent in the Greater Toronto area. So no one is making anyone live in 325 square feet. They can use their rent and their budget to go and buy and rent in a larger unit, but they are choosing to live in this smaller one based off their budget. So that's their choice. That's their choice. There's no
or forced to, because it's all that they can afford.
Yeah. So if that's all you can afford, what can you do about it? I mean, I would love, I'm in the apartment business. I'm in the high-rise business. I would love families to live downtown in apartments. That'd be great for my business. But unfortunately, I am also someone with 3 kids, and I know the people that live in my neighborhood, and it's expensive to live downtown, right? You don't want to carry your groceries up in the elevator. You want your kids to be able to walk to school. And a lot of times in the downtown area, the daycare is more expensive. It's difficult to drive your kids to hockey and baseball practice just because of traffic and stuff like this. So there's a lot more reasons than simply the fact that there's not enough of them. It's that, in many of the areas where the apartments are and high-rise living is most common, they don't cater properly to families, and that's why people are not buying them. And it's a value proposition, right? Well, there's rental developers right now launching 3-bedroom units at 1,200, 1,300 square feet, and they're $5,000 a month, right? So if you look at, okay, if I have $5,000, would I rather be in Danforth and Main Street, where closer to I am, and I can get an 1,800 square foot townhome with if it's a condo, I got no condo fee. I got 2 parking spaces. I got a little bit of backdoor space. My kids can walk to school. There's 8 other kids in our townhome complex to play with. They can just go out onto the street as opposed to going up the elevator to find the kids or going to the kids' playroom. So it just works a little bit better for families. I hope in the future that developers can start to program buildings with better, amenities for families, party rooms and theater rooms and games rooms, offer the type of programming that can bring those people together. But right now, we're just at a point where it doesn't make a lot of sense for families that have that type of budget to rent a condominium, or for a developer to program the units because there's just less demand, and so it's just not quite working.
Yeah, it's interesting because all of this just keeps coming back to affordability. And I think about this, and it's like, okay, you're a family, you make $250,000 a year, you can't afford to, you weren't blessed with parents who can give you a big down payment. So you're renting, you're spending $5,000-$6,000 a month. You've got $125,000 after taxes, after rent. You're down to like $60,000. You're a family of 2, family of 3. How are you doing anything other than subsisting? I don't know. And then how do you ever become a homeowner? I think it's impossible. And you're making what would be considered to be a decent salary, $250,000, either combined or single. I think it just keeps coming back to affordability. And I think that the housing situation, whether it's on the rental side or on the purchase side, and that dream is fading quickly, is really the key issue. And it's how do we as a society get around that? And I think nobody's presenting any answers right now. And I think we're just being in real estate, residential real estate, just seeing symptoms of the whole thing. And we're seeing inflation, we're seeing debt, we're seeing currency debasement, we're seeing taxes on top of taxes on top of taxes. Like, how many more taxes can they come up with that's going to be the solution to something?
Yeah.
And when do people just start tapping out?
Yeah. I mean, and I've talked about this on my podcast a few different times. It's, there's only so much land, right? If we were going to take it out for the green belt, and we're going to, take it out for other reasons, and we're not going to build low-rise housing, and people still, and as much as, people on Twitter don't like to hear it, that's still the most preferred way if people want to live. They want to live in a single family home or a low rise house with direct access. And again, I'm in the high rise business, right? I would love people to want to live in high rise buildings, but I just realize what their preferences are. And we're not building any more of those. And in fact, we're probably going to enter a time over the next 10 years where we're seeing more teardowns of low-rise housing than we see new ones get built. And Canada is in the unique position where we only have a couple major cities, right, where all the jobs are, all the high-paying jobs are located. So it's and where they're as welcoming to immigrants and what have you. Like, just Toronto is the center of the universe, right? Like, are you going to? I mean, Vancouver, obviously, one of the most stunning places I've ever been to. But it's more expensive than here, right? So if you're looking to move somewhere for affordability, it's not Vancouver. And yeah, you're going to move to Montreal. Again, beautiful city. Halifax, beautiful city. But Montreal has a language barrier, Halifax is still suffering from a little bit of small town. Yes, it's not Toronto, right? Like it's not the same. So it's not the same as living in the United States. When I lived in Dallas, right? You could move to Houston. You could move to you could go over to Vegas. You could you go over to Tampa. I mean, there's a lot more mobility, and there's a lot more big cities and a lot more choice, and again, a lot more sprawl too, right? They're going to start to run into problems in many of those cities where they've reached the limit of sprawl as well, right? Once when people say, "Man, I can't drive an hour and a half to work every day," right? Just impossible. So then they'll have to start, going up. Unfortunately, people will you either have to sacrifice on geography and say, "Okay, I'm moving to Edmonton because I want a big house," or you say, "Okay, I guess I'm going to raise my family in 950 square foot condominium," right? Those are the sacrifices ultimately people are going to have to make. And I know they don't like to hear that. But something has to give because we're not an unlimited resource. We don't have unlimited resources. And if we've decided that we want to, maintain greenfield properties and we want to have farmland and we don't want to disturb this and that, then housing has to move up instead of out. And
we do have the most potential
yeah,
resources in the world.
Yeah,
we just choose not to utilize them.
Yeah. So I don't know. I don't know. I'm not an expert on farmlands and green space and what can and can't be delivered. But you'd think in a country as large as ours that we could figure out a way to build housing cheaper than we are currently.
Yeah, something like we have the most amount of land available, and we're the slowest to grant permits, and we're the slowest at building, and we're the slowest at deliveries.
Yeah,
for no real explanation.
It's sad to see how fast our productivity has declined in this country, and
we're that of a third world.
Yeah, I'm obviously pro-immigration. My mother's an immigrant, but I think obviously there's a maximum number that or a number that we can bring into the country that helps us grow, and these people get jobs and they hire people and they're entrepreneurs, and then there's a number that's too much and it starts to overwhelm our healthcare system. We can't build the housing for them. We can't house these people. We can't service them properly with where the government their levels are, and obviously we went over that by a lot in the post-pandemic period, and that just kind of threw everyone for a loop, and unfortunately has brought in too much negative narrative as it relates to immigration, when we're supposed to be one of the most pro-immigration countries, but we went overboard, and it caused a lot of problems. And
10 years ago, we had the most envied immigration system in the world.
Yeah, the points-based system is the way to go, right?
Is the basis of every country's immigration system, and I don't know what happened 10 years ago, but something seriously broke, and it's unfortunate, but we are where we're at.
No.
So Ben, let's sort of wrap this up. Where do you see things going right now? I mean, resale still struggling. Condos in the last month on the resale side have showed a little bit of a ground floor, or a little bit more stability. What we're starting to see actually is a little bit of shakiness in low rise, in detached and semi-detached, which is something even in the great neighborhoods. We're starting to see something struggle that never would have before. Where do you see things going for resale, pre-construction, and purpose-built? I know nobody has a crystal ball and everybody seems to be wrong about everything, but you're an analyst and you look at market trends and you look at demographics, and then you give developers who typically think 3-5 years out advice based on that information. Like, at a high level, we're in a situation right now where it almost feels like for the industry, whether you look at the iPro or RICO or pre-construction sales or pre-construction platinum agents, it seems like the industry is really, really in disarray as a whole after, as you stated, a 27-year magnificent bull run. But now we're sort of looking for a reset. Do you think we'll hit the floor in 2026? And do you see a rebound? And then where do you see things moving, both on the pre-construction side and on the purpose-built side.
Sure. A lot to unpack there, but
Yeah, it was a very,
I
very
mean,
open-ended question as well.
yeah,
So
I mean,
take it wherever you see.
on the very highest level, I mean,
Yeah,
obviously we're not bringing in as much immigration, so there's going to be a little bit less demand. We are seeing unemployment rate increase slowly due to global uncertainty with tariffs and wars and things along those lines. So we're not going to have as bullish an economy as we've seen in the past. And when people don't have jobs or people don't feel confident, then they don't go out and buy major purchases, right? So that's just common sense. All right. In terms of the new housing market, certainly again, I'm in the condo space. I did mention I think the market's going to be flat, declining over the next 3 to 4 years. I think it might start to pick up in the fall of 2028. I think there'll be investors that want to jump right in. I think there will be developers that have owned land for a long period of time. I think costs will have increased. I think by that time, I think maybe we'll have seen some policy changes that can lower the costs. But I think revenue will ultimately be what causes the market to recover is values start to go back up again and people start to buy. So, I think it will pick up in 2028. Will it get back to the 10 or even 20-year average for sales, between 2002 and 2022? No, it probably won't happen until, at least the 2030s before we get to any, quote unquote normal new condominium market. I think we'll see more purpose-built rentals. Maybe we'll see 5,000 to 8,000 starts per year. Several condo developers will put their projects into the rental market. They will come up with the capital to do so, and some of that some of that capital will come by completing projects and paying those off and realizing their profit. Fingers crossed for those developers that people close and they actually get that profit on those units that they can now put into these rental projects. So, but like I said, there's not going to be enough rental to support the underlying demand in the marketplace, and ultimately we'll start to see rents and prices trend up. I mean, obviously in the resale market for condos, we're going to run into their fourth consecutive year of near record completion. So that's always going to have a negative impact on rents and prices, assuming the record level is above the underlying demand, which I believe that it is. So I think it's going to be fairly flat for the next few years in terms of rents and pricing. I think it's neighborhood specific. Obviously, the areas that had the highest amount of completions will see the biggest declines, and there's still many areas of Toronto that haven't seen a lot of completions, but are still desirable neighborhoods, and they'll do a little bit better than the ones that have seen a lot of supply. I think because the market is flat, I think there's going to be a lot of people that don't list and don't look to buy. So I think listings will go down. I don't think we're going to get as many, quote unquote distressed listings or people being forced to sell in the future. I think we're past that, but maybe I'm wrong. Right now that rates have gone back down and it's not as it's not 4, 5, 6% interest rates that some people are facing. I think that's a little bit better for distressed sales. And as a country, we've generally been pretty good at paying our mortgages first and sacrificing everything else. And so I think we're pretty good on that side of things. So yeah, I mean, I think it's certainly not going to be a fun 3 years in the industry. I think if people are going to have to work a hell of a lot harder to get the sales done. Ultimately, I hope that some things come out of this downturn that benefits the long term, better designed suites, better designed buildings, more focus on amenities and programming. I hope that we get away from this requirement to sell 70% of a condo building up front, and we can start to get slightly lower pre-sale targets. I think it's ultimately beneficial to the people who want larger suites, because obviously a developer is going to program units that they can sell in the pre-construction market, and investors tend to prefer the smaller, more affordable ones that are easier to rent and resell, right? The lower priced a unit is, the bigger the demand there is for it, right? I mean, that's not not shocking, right? The cheaper it is, the more people can afford to buy it, the more people can potentially buy it. So that's one of the reasons investors buy it. So if you can lower the pre-sale test, then developers may be willing to offer more big units that they know that people are much more willing to purchase when they can walk through it and get a feel of it and say, okay, this timing works. I've got 3 months and then I move in, right? Not this could be 3 years. It could be six. It could be 6 years, or it could get canceled in 5 years, and we'll give you your deposit back with 1% interest. Don't worry about it. You made a little cash on the side there, right? So, and that's ultimately the difficult part now is the uncertainty. There's way too many projects that have been in pre-construction for 3 years, which just is not fair, right? Like if I was going to put one extra rule on the pre-construction market, it would be you can't be in pre-construction for 3 years, right? Like that has to be the maximum, and then you have to give the money back, right? Like if you can't get your sales and financing aligned in 3 years, then you shouldn't be able to hold on to people's money for that long. And because it's typically the bad developers that are doing that, or ones that didn't properly, program their project, and that just hurts the good developers who did have their ducks aligned and did everything right, and then people are like, well, man, like I don't know if I want to buy with this developer because I just heard my buddy bought over here with this guy, and he's been sitting. They bought in 2021, and they haven't even done anything yet, right? And they won't give him his money back. So ultimately, I think it will be a benefit to the industry to have some changes like that.
Awesome. Ben, as always, thank you so much for joining us. Where can people find you?
I'm on LinkedIn. I still do a little bit of Twittering or Xing. It's bullpenconsulting.ca. I'm at patreon.com/Tuck Podcast. That's TUC. That's Toronto Under Construction Podcast. We talk to developers, lenders, landowners, maybe brokers. So we have some interesting conversations on there as well. And at Bullpen Consult on X if you want to get me there, and Ben Myers on LinkedIn. So again, thanks for having me on, Ralph.
Awesome. Always a pleasure. Thank you so much for tuning in. Please be sure to hit that like or subscribe button, and we will see you next week. Ben, so great to have you.
Thanks, Ralph.